of conventional lending in today's marketplace. My name is Kimberly Soash. I'm an account executive out of the OCLA branch, and I will be presenting the webinar today. We're going to discuss conventional lending. Today we're going to talk about some of the changes in the California marketplace, some of the product choices that are available for conventional lending, the high LTV borrower, conventional lending versus FHA, private mortgage insurance, PMI and the 3% cap, and down payment assistance. The national marketplace and home prices are up. This is good news for all of us and something we've waited for a long time. We're officially out of the refi boom and into the purchase market. The purchase market is here. According to CoreLogic, the national home prices are expected to rise 6.7% from March 2014 to March 2015. Nationwide home prices have increased a lot compared to 2013. California has got a 17.2% increase over 2013. Arizona at 11.1%, Colorado at 9%, Nevada at 15.5%, Oregon at 12.2%, and Washington up 10.5%. And these are the seasonally adjusted increases for purchases based on the house price index. So this is really good news. We're in a great place. It's exciting to share this. When we're in a purchase market, the first thing we think about is build up those realtor contacts. It's a great time to develop your realtor relationships. And hopefully you're calling them, you're visiting them, you're using all your social media tools, LinkedIn, Facebook, Twitter, and the real estate links that are available online also, like Redfin and Zillow. And I know there's a whole bunch more, but these are just some things that I'm hoping everyone's using to their full advantage in this purchase market. If we think back to a few years ago, there were over 85 product choices available in the last 5 or 6 years. Some of you may remember the CISAs and the CIVAs and the NEVAs and the NEVAs and the very creative products that were available. There were, 80 ways to Wednesday to do a loan 5 or 6 years ago. But in today's marketplace, it's a lot more vanilla. There's only about 15 product choices. If you have LTVs that are 80% or below, your conventional choices are pretty straightforward and probably don't need to be gone into with any detail. But conventional loans also offer benefits for your high LTV borrower. Mountain West offers a variety of product choices for all of your borrowers' needs. We are partnered, work agency direct even, with Freddie and Fannie doing DU and LP, offer DU Refi Plus, have Freddie High Balance offerings, LP Super Conforming, which is Freddie's version of High Balance, offer True Jumbo, My Community Mortgage, and many government offerings, FHA, VA, 203Ks, HUD Repair Escrow, HomePath, and USDA. Since our presentation today is going to be focusing on the benefits of conventional lending, we're just really going to talk about these conventional choices. So let's talk about FHA and the high LTV borrower. There's been some recent significant changes to FHA. Recently, they've increased the annual MIP. So it used to be that the annual MIP, which is the monthly MIP payment, and this is effective for case numbers that were assigned on or after April 1st of 2013. And we're discussing loans that have terms that are greater than 15 years and loan amounts that are less than $625,500. So it was the case that the annual MIP, or the monthly payment, had a factor of 1.2% for loan amounts that were equal to or less than 95% LTV. That's been increased to 1.3%. And loan amounts that were greater than 95%, the increase went from 1.25% to 1.35%. Another significant change that FHA has made is a revision to the assessment period of annual MIP, and this was effective June 3rd of 2013. Again, for loans that are originated with terms that are greater than 15 years. But it used to be that MIP for FHA could go away eventually. But now, if the LTV on an FHA loan is greater than 95%, the annual MIP is not cancelable. It cannot be, it's a life sentence for the FHA borrower. They're going to have to be stuck with it for the entire term of the loan. On an FHA loan where the LTV is 95% or less, the annual MIP could be canceled at the end of the loan term for the first 11 years or whichever comes first. So the soonest amount of time that an FHA borrower could get out of their MIP payment with FHA would be at a minimum 11 years. So here's where we think about conventional, and what would conventional loans offer to our high LTV borrower? Conventional offers PMI choices. Private mortgage insurance has many choices for our LTV borrowers. Mountain West Financial is partnered with some of the best PMI companies. MGIC, whose website is www.mgic.com. Radian, whose website is www.radian.biz. Essent Guarantee, whose website is www.essent.us. Or Genworth, who has the longest website of all, www.mortgageinsurance.genworth.com. So mortgage insurance, private mortgage insurance is having, excuse me, private mortgage insurance is enjoying a perfect climate right now. For an LTV that's greater than 95%, FHA may still be your best bet. But if your LTV is at 95% for conforming loans and at 90% for your high balance or super conforming loans, then PMI is really going to shine. Conventional conforming loans can go 95% for purchase rate and term. They can go 85% for owner-occupied cash-out LTVs, and they can go 90% LTV for second home purchase rate and term. The FICO requirements for all of these for conventional conforming loans is going to be 620, with the exception of manufactured homes, which would require a 680 credit score. That's your conventional option. If you're looking at the high balance or LP super conforming, again, your Freddie high balance option, we could go to 90% with PMI on purchase rate and term. And again, 620 credit score. This is for your single-family residences, condos, and PUDs, with the exception of LP. On a high balance loan, LP doesn't allow for condos. So let's talk about some of the PMI options, because it's not like FHA where you only have your upfront MIP and your annual MIP. You have all kinds of options when you go into PMI. So with PMI, you could do borrower paid MI. This would be where the borrower pays a monthly MI payment. This can be refundable or non-refundable, and the MI payment factor for private mortgage insurance is going to be lower than it is for FHA. Another option that PMI offers is lender-paid MI, and this is where the borrower has no monthly payment. The MI payment will be factored into the rate. This is where they'll have a higher interest rate but no monthly payment. Another MI factor would be single premium, and this is where, again, the borrower would have no monthly MI. The lender-paid MI and the single premium MI are really good things to consider if you're having a tough time making your debt ratios work. So the borrower's MI payment is just killing your debt ratio. Maybe you look at a little bit higher interest rate, you have lender-paid MI, or you go single premium, or the borrower just pays out the MI upfront and has the lower monthly interest rate, has a lower interest rate, so a lower monthly payment, and no MI to calculate. This premium can be paid up front, it can be paid out of seller concessions, or it can be paid out of pocket by the borrower. There's even an option that PMI offers that's a split between the two. It's called split premium. And this is where you would reduce the MI payment, so you didn't get rid of it, but you have reduced it, and the borrower has paid a slightly less payment of a single premium up front. So they pay up front and they pay monthly. Whenever the borrowers do a single premium where they're paying it out of pocket or paying it up front, or the split premium, it cannot be financed into the loan. It needs to be paid by the borrower or paid out of seller concession. Let's talk about some additional good things to know about private mortgage insurance. Your debt ratios are going to be per your AUS findings. You must receive a DU, approve eligible finding, or an LP accept finding. The borrower contribution is going to be as determined by your AUS finding, but not less than 3% of the borrower's own funds. Gift funds are okay. And the reserve requirement is going to be per your AUS finding. So let's take a quick look at what an MI fee sheet would look like. So if you go to the website, one of the websites of the MI companies that I provided earlier, we might look at a fee sheet. The fee sheet's going to have columns of credit scores and rows of LTV. So if we were looking at 95% LTV and we have a 620 credit score, we'd be in this 620 column. We'd be in this 95% row. This yellow bar on each of these columns indicates what the amount of coverage that is required for this tier. So for this tier, we need 30% coverage. We have 95% LTV. We have 620 credit score. So the MI factor for this borrower is 1.15. So we were looking at 1.30 or 1.35 with FHA. So you can see how the factor, the monthly MI factor, is lower. With private mortgage insurance, you can see how if the borrower has better credit, they get a better MI factor. So here we have 1.15 for the 620 borrower. We have 0.89 if the borrower has 680 credit. 720, they're at 0.62. And borrowers with 760 credit are at 0.54. So you would take this MI factor, times it by your loan amount, divide it by 12, and that would be your monthly MI payment. If the borrower didn't want to have an MI payment because we've got really skinny debt ratios and we're trying to buy out the payment and avoid MI altogether, then we would go single premium. So single premium means that they're going to pay in advance and not have an MI payment. So you can see that the borrower with a 620 credit score, the single premium is kind of expensive. It's 4.44 cost. So that's 4.44 times the loan amount. That's what your MI single premium cost would be. That's kind of expensive, even if you have seller concessions. Yield spread and seller concessions can help with this. The borrower with 680 credit score is got a cheaper single premium fee, and the better the credit score, you can see the better and lower that single premium cost is. So 2.48, 2.15. This may be a very reasonable fee for someone with seller concessions or a fee that they even want to pay out of pocket. Also looking at these sheets, and these sheets are going to vary from PMI company to PMI company, but they're all going to include the same sort of information. So be sure when you're looking at whatever these fees are that you've included the adjustments that are at the bottom of the sheet. So it's going to have adjustments for cash out or adjustments for manufactured housing or rate and term, refinance, or what have you. And they're going to differ depending on if you do monthly or single premium, but you want to be sure that you include them. The big thing to remember, though, when we were talking about the FHA changes to mortgage insurance, the annual mortgage insurance, was one of the changes that it can't go away, or that the term is the least amount of term is 11 years. With private mortgage insurance, it can go away. This is the best part about private mortgage insurance, is that it can go away. So for a borrower to terminate or make their PMI go away, what would they have to do? Well, there's an automatic cancellation policy that takes place when the LTV reaches 78%. So when their equity has increased enough that the LTV is at 78%, the PMI will terminate itself. The borrower can also initiate the cancellation of their PMI. So when the LTV ratio is at 80% or less, and if the borrower has 0 late times 30 in the last 12 months, or 0 times 60 in the last 24 months, and the borrower would need to provide an appraisal that certifies that their LTV is now at 80% or better, then the borrower can initiate the cancellation of their policy. Now, depending on the PMI company, it could require a 5-year seasoning period. Not all of them require that. Some do, some don't. You would want to make sure that you understand the particular policy of the PMI company that you choose. So let's take a moment and compare PMI to FHA. So let's say that we had a $300,000 purchase with 5% down payment, and we're doing borrower paid MI. So let's say that our borrower here in this FHA instance is a 620 credit score. We're using an interest rate of 4 1/4. Government rates are generally lower than the conforming rates, the conventional rates. So we have an interest rate of 4 1/4. We have a base loan amount of we have a base loan amount of $285,000. In the FHA model, we have a $4,988 of upfront MIP. So we add this to the loan amount, and now we have a loan amount of $298,988. Right away, we can see the benefit of going conventional and using private mortgage insurance because our borrower's loan amount doesn't change when we go conventional and use PMI. The borrower's loan amount remains at $285,000. With the PMI factor that we use for FHA of 1.3, our monthly mortgage insurance is $306 a month with FHA. Now, we were looking at that price sheet earlier. So if our borrowers have really good credit, their MI might only be $128 a month with the 760 credit score. Or maybe it's $147 a month with a 720 credit score. Now we have a borrower with a 620 credit score. So again, remember the factor was lower for PMI than it was for FHA. It was 1.15%. So our monthly MI payment in this model is $273. But also remember that since our interest rate was higher, this borrower had to get a 5% interest rate. So their PITI plus MI, this also includes the MI payment, in the FHA is going to be $1,733 with the borrowers with really good credit scores. You can see the significant savings for these borrowers, $1,572 and $1,591, because they have the lower MI payment, lower credit, higher FICO scores. But our borrower over here on the conventional with the 620 credit score, he actually ended up with a little bit higher monthly payment, $1,803. But not to fear, because the thing to consider when still looking at this model is that here the MI cannot be canceled for this borrower. So this borrower has the MI at least, possibly for the term of the loan, at least for 11 years. Here, we're likely getting out of this MI payment in 3.7 years. So when this borrower gets out of his MI payment, gets rid of the $273 MI, and his monthly payment will drop from $1,803 to $1,530. So that's in possibly 3.7 to 5 years, he's got a significant savings over the FHA borrower. Let's look at the LPMI model, which is when the lender would be paying the MI. So here we've baked the MI into the rate. So they're not going to have, again, no upfront MIP with this model because there isn't any on conventional loans. The monthly MI payment has gone away because we didn't buy it out, but we baked it into the rate. And the monthly PITI payment here, again, is the same with the FHA as it was before at $1,733. But in these models, you can see, again, as the credit score is better, the monthly payment is obviously better. Here we're at $1,508, $1,508, and $1,574. Now, I want to point out that at 5 1/4, so this was a higher rate than the model we looked at before, which was, which was at 5%. So this one's at 5 1/4. But this was also at a cost. So for us to do LPMI for this borrower to get this rate, this was at a cost of 1.449. So the lower the credit score, it can be expensive. The higher the credit score, the more advantageous some of the PMI choices are. But still, if we have seller concessions or we have yield spread enough to cover these costs, we were able with LPMI to get a much lower monthly payment for this borrower than FHA would have allowed. So while we're talking about FICO, because we can see that a higher FICO score is obviously an advantage for our borrower who's using private mortgage insurance. a few little tidbits that you might not know is that 53% of consumers have a FICO that is 700 or greater. 65% of consumers have a FICO score that is 650 and above. And the median FICO score in the state of California is 611 to 622. So it is more expensive for our borrowers with low credit scores at times, but we do have a significant amount of borrowers who are going to be able to take advantage of the pricing that is available for higher credit scores. So let's talk a little bit now about PMI and the 3% cap. If a borrower is going to do a monthly premium where they're going to have a monthly MI payment, this will not be included in the points and fee calculation of your 3% cap. If we have a borrower who's going to do borrower paid, so the single premium, non-refundable, the entire upfront premium amount will be included in the 3% cap, and that is regardless if it is paid by the borrower, financed into the loan, or paid through a seller or builder credit. So that's for borrower paid MI that is non-refundable. There's also borrower paid MI that is refundable. If a borrower chooses to do a refundable borrower paid MI, the upfront premium that is in it, the upfront premium amount that is in excess of FHA's upfront premium will be included. So regardless if this is paid by the borrower, financed into the loan, or paid through seller or builder credit, whatever is in excess of FHA's upfront premium, that would be included in your 3% cap. You know what, let me go back to that slide. Something that's not included here, lender paid MI would not be included in the 3% cap. So let's talk about some other advantages that PMI offers that you might not have been aware of. All of the PMI companies offer an amazing amount of tools that I think you'll find very useful. If you go to the website that were provided earlier, you can find the PMI rate sheet and grids that shows what the costs are for monthly MI, single premium. They also offer rate comparison tools, so you could do side-by-side comparisons of FHA and conventional loans with PMI. So the comparison that I showed you today, you can do on the PMI website using their rate comparison tools. They offer a large variety of marketing materials. They have recorded webinars. They have recorded webinars that will go into far greater detail about PMI and using PMI. They have recorded webinars also for qualifying borrowers and income calculations and self-employed income and such. And they also offer first-time homebuyer seminars. And some of the down payment assistance programs require that borrowers take first-time homebuyer seminars, and the seminars that are available on the PMI website are acceptable seminars. So let's talk about some other options that you might not have been aware of with conventional lending. Conventional lending offers a product called My Community Mortgage. So this is a product that's available only for first-time home buyers. It's for buyers and it can be used for buyers that are using non-traditional credit to qualify. My Community Mortgage is for owner-occupied, purchase rate and term, single-family condos or PUDs. The max loan amount for a My Community Mortgage would be $417. It's for 1 to 4 units. But the nice thing to point out here is that it goes to 105% CLTV if you're using a community second. So the FICO requirement is as determined by AUS. And I just wanted to bring this up because I think when we think about conventional loans, we think about just the standard DU or Freddie, LP, DU and LP, the Fannie Freddie products. But My Community Mortgage is a nice product out there for first-time home buyers that you might not have been aware of. While we're talking about down payment assistance, I think sometimes we think about down payment assistance and that it only goes hand in hand with FHA, and that's not true. I think you would be pleased to know that Mountain West does a better job with down payment assistance than I I think almost any other lender. It would be hard-pressed to find a lender that is as competitive in this arena as we are. If we went to the website for Mountain West Financial, go to www.mwfwholesale.com. There's an entire list of down payment assistance programs that are available, and I think at last count we have over 60. Click on the Affordable Housing tab under the menu section, and it will list all of the programs. Now, some of these are meant to be combined with FHA, but many of the programs are available to be used to be piggybacked with conventional loans, and some of them can be combined with one another. So some of the programs that can be used with conventional loans are the CHDAP. I think everyone's pretty familiar with CHDAP. The City of Carlsbad First-Time Homebuyer Program is a program that can be used with conventional lending. City of Pomona Mortgage Assistance Program, Colusa County First-Time Homebuyer Program, Riverside County Individual Development Program, and there's a Whittier Police Homebuyer Incentive Program, just to name a few. So again, please visit our website. Go to www.mwfwholesale.com. Go to the Affordable Housing tab, which is under the menu section, and look at all of the down payment assistance programs that we have to offer. Many of these can be combined with conventional loans, not just FHA. So there's a time and a place for everything. FHA loans have a time and a place, but there's really never been a better time for conventional loans. Conventional loans have a far greater product variety. With PMI, if we have borrowers that have a high loan-to-value, over 80%, we have PMI Choices for those borrowers that are going to have much, much lower MI costs. We could have a lower MI monthly payment. We could have no MI monthly payment with the PMI Choices that are available. And we have down payment assistance options also for our conventional borrowers. That is not just for FHA, it's for conventional also. So I want to thank you so very much for attending today's presentation. I strongly encourage you to contact your account executive to strategize the best options for your borrowers, the best fits for your borrowers, and I look forward to closing some loans together. Thank you so very much.